Hello, welcome to Micro Atlas. Today we're going to be discussing oil and how it affects risk assets such as Bitcoin. So what I'm going to be showing right now is my trading notes as usual. This is how the research that I do before I conduct my trades, and I hope you can learn something from it. I do like to make YouTube videos while I'm making research because it motivates me to actually structure my ideas better and teach them. And if you teach them, then you will learn yourself, right? So two birds with one stone, I guess. First of all, a little bit about me. I'm Mo. I'm a computer and data scientist, and I've been a crypto and macro markets trader and speculator for the past 7 years. I was able to turn a small portfolio into six figures this cycle, and I hope my trading experience can teach some people. And in the process, I hope to improve my strategies and both my macro analyst and my technical analyst skills. So, oil has been rising recently. We all know about that. And it's due to several reasons. The most prominent one is the Israel and USA war on Iran. So, Iran now is hitting critical infrastructure that is related to oil and gas and energy in the Gulf region. And similarly, America and Israel are hitting energy infrastructure in Iran. And the biggest factor that is affecting oil prices is the closure of the Strait of Hormuz, which 20% of the world's oil pass through, and this is why we are seeing these prices. So my base case is that the Strait of Hormuz stays closed for a longer period of time. Right now, Trump just a few days ago, he posted that he's doing negotiations with Iran and blah blah blah, right? And Iran just put out a statement, no, they're negotiating with themselves. And today they said that the Strait of Hormuz will stay closed until their demands is met, which gives you the impression that escalation is more likely by the day than de-escalation. And therefore, as market speculators, we should, unfortunately, um, try and understand the factors that go into that and hope to make money in the process. Yes, of course, a lot of people, we should understand that current conditions are not so nice. A lot of people are being affected and there's a lot of pain going around, but we are market speculators, and when we see an opportunity, we should take it. And we should hope as well that things do get better. But if things do not get better, then we shall be prepared, right? First thing you can notice is that oil is up, but Bitcoin has not really seen a major downtrend yet, right? We have been kind of trading higher and higher uh, throughout the whole period. Some weakness is being shown in the market, right? And that is understandable, but the closure of Strait of Hormuz happened around 6th of March, and you can see we have just continued the consolidation and went even made a local higher high. Now, a lot of people are confused and ask me a lot of questions, friends and family and on YouTube alike. They're like, why is Bitcoin going up and gold is going down and the stock market is going down when there's an oil crisis around the corner? Well, the key word here is around the corner. The oil crisis did not trickle down to the economies, did not really force the Fed to do any major hawkish decisions yet, except that we pushed out maybe the reduction of interest rates or cutting interest rates, but that is not enough to trigger a catastrophe in the markets. But we are on the way to seeing the catastrophe. I did some research and I've studied the effects of oil on markets throughout history, and of course with talks with some AI and some research on the internet. I found that if oil stays within the range of 70 to 85%, then we do have a 10 to 20% chance of being trickled down to the economy. Before we continue here, we should define how does it trickle down to the economy. The first signs of trickle down is, of course, in headline inflation. Not core inflation, but headline inflation. So the first thing that would be affected rather immediately, probably on the next data point, which is 10th of April, headline inflation should trickle up. And this will not really trigger any major decisions by the Fed or any major reaction by the markets unless it is a knee-jerk reaction. So we just volatility will spike in either direction. For different assets it affects differently, but we should just see knee-jerk reaction and volatility. However, when things start to get important is when rising oil prices start to trickle down to core inflation. So headline inflation, if you do not know, it includes oil prices and I believe housing and stuff like that, right? It also includes goods and services and all the inflation stuff. But core inflation does not include energy, such as oil, which means it indirectly gets affected. So headline inflation is directly affected by energy prices such as oil, but core inflation is not directly affected, it's indirectly. Indirectly is because oil prices go up, so production of goods and services go up slowly. Factories start to put up price and products and services start to go up in price, right? That's when you see core inflation getting affected. And when core inflation gets affected, that's when the Fed starts to care. And they start to care a lot in a meaningful way. So you might start to see a more hawkish stance in the Fed meetings. You start to see plans to raise interest rates. You start to see cut spending and less money printing. Now, just to give you a perspective on why crypto might actually be going up, nobody is noticing, but M2 supply just made an all-time high. This might be just a small high if inflation and oil prices continue to go up, and this will probably put even more pressure and more validity to the thesis that a crypto bear market and a bear market in general will happen to all risk assets. With that said, I hope that background helped you. There's of course other things that we will discuss maybe in different videos on the triggers that we might actually track to understand the effects of oil before it happens, before it trickles to core inflation. Because when it trickles to core inflation, everybody knows the story and what's going to happen. But we want to know before that. So there are also some signs and triggers and economic data that we can look at to determine the rise of core inflation, to predict and speculate on it before it actually happens, right? But that's not the core of this video. The core of this video is understand how, this is simply what it is, how high does oil need to stay and for how long for us to see, for us to increase our conviction that a bear market could happen, more likely to happen, right? First of all, let's determine the levels, the important levels that oil need to stay within in range to have a meaningful impact on inflation and economic downtrend. So also, if you get fears of recession and higher inflation, you get stagflation, which is much, much, much worse than just a recession. It's sticky, the Fed cannot do nothing, their hands are tied, and they just need to wait and for the crisis to just pass by. Because they cannot reduce interest rates, because inflation is high, and the economy is slowing down, so they cannot really boost the economy at the same time. So that's why you get the big problem, right? So if we stay between the 70 to 85%, 85 price range, we get a 10-20% chance that we will have problems in economy and it will trickle down and cause recessions and inflations, right? But if we stay within the range we're at right now, which is between 85 and around just below 100, then we do have a 30-50% chance. If we go up to the 120 level, then here our odds start to really get serious, between 60 to 80% chance. And of course, if you go up to above 120, then the chances just get too extreme and too likely to happen. Even within a month time range, if you stay within 120 to 140, you get inflation trickling down to core, not just headline, and stagflation risk increases if growth is slowing down and employment rate is rising, right? So historically speaking, price has to stay within those range at least 2 months. So 2 months is not even enough, right? So we need to pass the 2 month period. So if you calculate the date, which is 6 March, where we reach that price, that range, we're around just 20 days in. So we need to reach 60 days. We have 40 more days. If we stay within that range, then we start to see risk of inflationary risk, right? Heading to core inflation. And that is where the thesis gets a little bit more serious, and the bears start to have more higher conviction, and shorts will start to pile up. Right now, the markets are not moving much because this might be a temporary spike. Maybe there will be de-escalation or a ceasefire agreement or something like that. That's why you're not really seeing markets move as much as you would think for scary headlines of oil rising, right? But if you do the analysis and see that sometimes oil does go above these ranges, and if you put recessions, yeah, that's a recession. We didn't even have a recession during that period, but oil stayed above for around a whole year within that range, right? And you might question why. Well, there are several reasons why oil did not cause higher. Actually, we did have higher inflation, but it did not cause a recession, and that's because we did print a lot of money and stimulate the economy down here, and therefore the economy was able to handle an energy shock as such, right? But inflation, well, let's start with headline inflation, did actually rise, right? Just it followed it. Um, you can see oil price goes up and headline inflation goes up first, and then the yellow line, which is core inflation, orange, it goes right after, and it catches up fast, right? So it catches up fast. It takes some time to follow headline inflation on oil, but it does catch up fast. Previously, during the 2022 peak, let's say, um, there was recession fears, right? A lot of it. And there was actually a Bitcoin bear market, if you don't remember. Yeah, see, Bitcoin had its bear market during that period, and we started to see some trends when oil was stabilizing within a good range. But right now we're actually predicted such a thing, and we fell before oil rises. So Bitcoin sensed that the economy was weakening, that the future is not as bright as previously, and therefore we went down. So risk assets do predict the futures, and they do sense weakness, right? Which is pretty interesting. Even here, before we spike to the scary levels that we do not want, the pressure building levels, Bitcoin had fallen off a cliff before then. So it's interesting to see, right? Right now, of course, the recent spike is too recent for it to show any data points for the inflation, but I expect that headline inflation at least ticks up a little bit by April 10, and core inflation would follow up a few months after. Yeah, so usually it does take 2 months, and this is some from the research I did. What's the time frame, and what do we expect within those time frames at the different levels, right? So if it's less than 1 month, it's usually too short, and it doesn't matter much for core inflation, right? It's just headline inflation and CPI noise. It doesn't do much. Let me increase that for you to see better. Yeah, amazing. So that's one, but 1 to 2 months it does create some market fear and some pressure, but it's not enough by itself to really push up core CPI, right? But if the shock is large, so if we are at those high ranges, then this becomes more risky. Again, if we are above 120 for a month or so, then core inflation will get affected, and risk assets such as Bitcoin will definitely fall. But if we stay within that range for 2 months, then we might have some some risk, around 30 to 50%, um, but it wouldn't be enough alone to trigger a trade. We would have to understand and look at other data points and see the effects of rising oil prices and the health of the economy. Can it absorb the higher inflation and the lower spending that is people gonna experience, and will people start to ask for higher wages, or are they not, for example, right? So of course that's one factor, and once we get closer to the point, we will have to analyze other factors to determine the validity and the probability of our thesis succeeding, right? First of all, this is not financial advice, it's for education purposes only, and I hope you can learn a few things from it, right? But if we do pass the 2 4 month period, which is the period at which I would definitely start to be worried and build up my short positions. I'm already building up my short position, right? But it's minor to the amount to the capital I fully want to deploy. But when we pass that 2 to 4 month period, and some weakening start to show, for example, employment rate going up, or the people start to ask about wage increases and all that stuff, then it's definitely something to be worried about, right? So 2 to 4 months, this is where the risks become more serious, and especially firms start to pass these costs to customers. You start to see rising prices, and you start to experience it in real life. Then stagflation might be coming. We could probably have inflation without recession, and that will be much better. That will be easier to go through, right? But if it's a stagflation, then we might be in for a few years, and that's not so good. Not for for investors as well, right? Trading the long side is for me at least much easier than the short side, and I don't want to trade the short side for like 2 3 years, right? 1 year is enough. So 4 to 6 months, the odds become much higher, and the shock has become longer, not just temporary. That's when people start to ask for wage increases, and services and goods start to go up in price meaningfully, and everybody can just see it, but traders, you have to see things before everybody sees it to actually make money in the markets, right? If you just go in when everybody is in, then you're just a little bit too late. So 6 to 12 months is just, it becomes more severe and become more structural, and it does stay for a much longer period of time, so it would affect our lives in meaningful ways for the next decade or so, and we do not want that. So that's a little bit of a timeline just to get your perspective a little bit more in line with how it actually happens. It doesn't happen in a day or two or a week or two. It does take time, and the levels at which we stay at every day do matter in the probabilities of possibly having a recession or not. Last thing I do want to, this is a little table. I'm just gonna maybe walk you through it. We can go through ChatGPT. He made me this nice table. We will speak of real yields later, which are very important. This is one of the signals that can really confirm our bearish bias or not. But you can pause it if you want. I'm just gonna point out a few. If we stay